Hi everyone, welcome to this week's Advisor Market Update. This week delivered unmistakable signals about technology, leadership, global competitive dynamics, and structural forces reshaping interest rates. From AI platforms hitting escape velocity to Chinese EVs dismantling Tesla's European dominance, here's what advisors need to know about the shifts redefining portfolio positioning. Let's dive into what matters. Let's start with the breakout story of the week, Palantir. The company just delivered its first billion-dollar quarter with 48% revenue growth. That's 8 consecutive quarters of acceleration. But this isn't just another earnings beat. It's validation of the platform approach to enterprise AI. While competitors chase individual use cases, Palantir's integrated offering is creating switching costs that translate directly to pricing power. Yes, analysts are worried about the valuation at 100 times forward earnings, but the acceleration trajectory suggests we're still in the early adoption curve. Companies that demonstrate measurable ROI from AI investments will command premium multiples, and Palantir is setting the standard. Now let's talk about a surprising turnaround, Pfizer. Pfizer beat estimates and raised 2025 guidance, proving that execution can overcome structural challenges. The surprise wasn't just beating lowered expectations, it was achieving margin expansion while navigating drug pricing reform and patent cliffs. COVID product sales stabilized above pessimistic forecasts while cost-cutting initiatives are running ahead of schedule. This underscores a broader theme in healthcare. Companies with diversified portfolios and operational discipline can thrive despite policy uncertainty. Pfizer's turnaround suggests opportunities in oversold pharma names where sentiment has disconnected from fundamentals, but not everyone's winning. Let's look at Tesla. Tesla sales fell 55% in both the UK and Germany. Meanwhile, Chinese competitor BYD posted 400% growth in those same markets. This represents more market share loss. It's a fundamental shift in global EV competition. Chinese manufacturers aren't just competing on price anymore, they're delivering superior technology at scale. Tesla's inability to respond effectively suggests its first-mover advantage has evaporated in key markets. This isn't a temporary setback. It's structural disruption from competitors who learned from Tesla's playbook and executed better. For portfolios, this demands reassessing EV exposure through a regional lens. Now let's examine the broader economic landscape. The 10-year Treasury yield is moving higher, and there's a reason. Markets are beginning to price a new inflation regime. This isn't the transitory inflation debate of 2021. It's recognition that policy choices are creating persistent price pressures. We're seeing the compound effect of tariffs, fiscal stimulus, and supply chain restructuring. The services sector, representing 80% of the economy, remains stubbornly inflationary due to wage growth and housing costs. For fixed income positioning, this environment favors shorter duration and inflation-protected securities. The geopolitical landscape is shifting too. Russia just publicly defended India's right to buy Russian oil despite US pressure. This isn't just diplomatic posturing. It's evidence of a new energy order taking shape outside of Western frameworks. India's willingness to risk US tariffs for discounted Russian oil demonstrates how economic pragmatism is trumping geopolitical alignment. The dollar's weaponization through sanctions is accelerating alternative payment systems and trade relationships. Traditional emerging market correlations are breaking down, creating both risks and opportunities. And here's something markets are still underestimating. Bloomberg Intelligence research shows baby boomer retirement is fundamentally changing interest rates. As the largest generation shifts from savers to spenders, the supply-demand balance for capital is changing permanently. This demographic transition coincides with deglobalization and climate transition financing needs. Unlike cyclical factors the Fed can influence, these are structural forces that will persist for decades. Markets still pricing in return to zero rate policies are misreading this generational shift. With these dynamics in play, let's look at where opportunity is emerging. SoftBank just made a massive bet on AI infrastructure. They've dramatically increased stakes in NVIDIA and Taiwan Semiconductor Manufacturing Company while building new AI data center ventures. This represents a sophisticated play on AI's physical build-out. While markets obsess over software applications, SoftBank is positioning for the infrastructure required to support AI at scale. Their partnerships with OpenAI and Oracle create an ecosystem that's harder to replicate than individual investments. This highlights opportunities in the broader AI supply chain, from semiconductor equipment to power infrastructure, as computational demands explode exponentially. So, what are this week's signals telling us? Technology leadership is crystallizing around platforms that deliver measurable value. Palantir's acceleration proves this. Operational excellence still matters, as Pfizer's turnaround demonstrates. But competitive dynamics are shifting violently, with Tesla's European collapse showing how quickly advantages can evaporate. The macro backdrop is equally important. Persistent inflation, structural rate pressures, and fragmenting global trade all demand portfolio repositioning. And in technology, the real opportunity may be in the infrastructure enabling AI's rise, not just the applications themselves. Thanks for watching, and we'll see you in the next update.